Well, first look at the Asian markets. There's nothing incrementally new coming in terms of uncertainties from the global markets, and the Asian markets are taking it as a positive. So Brexit uncertainty continues. We have uncertainty over trade tensions that continue. Nothing incrementally new is something that the Asian markets take it as a positive. So the Nikkei ending higher, or rather trading higher, with a gain of about 0.9%, and that's also on the back of some weakness that we're seeing in the dollar yen. So from lower levels of, or rather stronger levels of close to 111, the dollar yen has now weakened to closer to that 112 handle. We'll keep an eye out on how that trades. Kospi as well, the Korean index trading about 0.5% higher, as well as the Straits and the Taiwanese indices. The Straits mildly above the flat line, while the Taiwanese index 0.25% higher. The SGX Nifty, with regards to that, or in light of that, is indicating a mildly soft start on the flat end. Let's see how that comes about, because remember, we've seen a stellar rally over the last 4 trading sessions. Yesterday was a bit of a consolidation. Let's see how today pans out. So that's as far as the Asian markets are concerned.
All right, then let's talk about the US markets, where the stocks closed mostly low as investors digested news reports suggesting progress towards a US-China trade deal has stalled against the backdrop of weaker than expected Chinese economic data. The S&P 500 and Nasdaq Composite closed lower, snapping 3-day winning streak, while Dow managed to eke out 7 points gain at close. On the data front, new home sales fell 6.9% in January, which was more than expected, and a sign that the US government shutdown could have kept buyers on the sidelines. Meanwhile, weekly jobless claims increased more than expected last week, and we have Aditi Roy getting us a wrap of all the action on Wall Street.
U.S. stocks finishing the day mixed. The Dow up 7 points, the S&P closed down 2.5 points, and the Nasdaq closed lower 12.5 points. The S&P and Nasdaq both snapped 3-day win streaks. U.S. weekly jobless claims increased more than expected last week, with the number suggesting that the labor market is slowing, but probably not to the extent indicated by the near stall in job growth in February. The Connecticut Supreme Court ruling that gunmaker Remington can be sued over how it marketed the Bushmaster rifle used in the Sandy Hook Elementary School shooting in 2012. The plaintiffs in the suit are a survivor and relatives of 9 people killed in the shooting. Remington has denied wrongdoing, previously insisting it can't be sued under the federal law. Toyota upping its investment in U.S. plants by $13 billion by 2021. The new plan is a 30% increase from the $10 billion investment in U.S. factories the automaker pledged in 2017 to make over 5 years. The new plan includes adding 600 manufacturing jobs and ramping up production of fuel-efficient vehicles. That's the action from the U.S. market. Back to you in Mumbai.
All right, that's what took place on Wall Street last night, but let's get in some opinion coming in from the market experts on the US-China trade negotiations, as well as their impact on the markets itself.
We've been pricing out tail risk on the bad news side. Tail risk as it relates to Brexit, and certainly as it relates to China. So as long as it still looks like the two sides are on track to reach a deal, there's not going to be sort of an implosion here and tariffs that go back up or rise even further than they did last year, the market's going to be, I think, relatively happy with that. The specifics of the deal seem a lot less important. The discussion of GE and industrials is a pretty good stand-in for some of our concerns, which is that we got up to a really fast start. We priced out a lot of the bad news, but the big question is, with negative earnings momentum and concerns that 2020, yes, we could see earnings growth in 2020, 2021, we could avoid a recession, but we're still talking about mid-single-digit earnings growth versus last year when we had 20 or 25%. Those days are not going to come back, we don't think. Economic growth is going to be slower this year, is going to be slower next year. So the upside that the markets seem to be latching onto at the moment, or have latched onto in the first quarter, we're not sure it's going to continue. That momentum may slowly dissipate.
I think there will be a deal. There's an awful lot of pressure on both sides to do that. Obviously, the details matter, but I think a lot of this has to do with protecting technology. So I think to the extent there's a lot of protection, that's probably the thing that is most important. I think what's going to happen is you've seen a great start to the year, and then I think you're going to get some more volatility. The central banks are going to continue to be accommodative. Just a year ago, we were talking about maybe 2 or 3 more rate hikes, and now the talk is we're probably on hold. So central banks around the world are very accommodative, especially in Europe. And I think that will continue. And if you look at the U.S., I think a lot of expectation that the unwind of the balance sheet will slow down. So I think central banks are definitely driving the markets.
Well, let's move on to the ongoing story. UK lawmakers have voted in favour of seeking a delayed departure from the EU for at least 3 months. Members of Parliament voted 412 to 202 for an extension of Article 50, which sets out the EU departure process beyond its current March 29 deadline. CNBC's Willem Marks reports on the same.
It was the third consecutive day of Brexit votes in the House of Commons as the British government and Parliament sought to find a way through what has been a months-long political deadlock. On Wednesday night, lawmakers had sought to rule out the possibility the UK could leave the European Union without some kind of withdrawal deal. And tonight, as part of a logical next step to avoid that so-called no deal, the government offered Parliament an option to try and delay Brexit beyond its original March 29th deadline. A resounding majority of MPs seized that opportunity. But before that, MPs also voted against a second referendum and against an opportunity for the House of Commons itself, rather than the government, to take control of the Brexit process. All this now means that, in theory, Prime Minister Theresa May must next week travel to Brussels to request that her 27 European counterparts give Britain more time. But there's no guarantee those EU leaders will grant that extension, though few of them want to see Britain leave without a deal either, given the damaging economic consequences. May and her allies are hoping that they can use the threat of a much longer extension to persuade rebellious members of the Conservative Party to back her original deal. If that helps it finally pass next week, it could only require a short technical extension, and the Europeans might be more happy to oblige. But these are uncharted waters for a British leader and government, and her opponents and critics know it. One big question centres on whether Parliament will be able to form a majority that supports an alternative to May's deal that would give the Europeans a good reason to extend beyond late June.
All right, and as a result of that, we did see the European markets monitor developments out there. Investors prepared for UK Parliament's next Brexit vote on whether to extend Britain's March 29 deadline, the Article 50 as we know it, to leave the European Union or not. And as a result of that, we saw big moves coming by in all the frontline indices. The French index, in fact, performed with a gain of almost 0.8%. The big underperformer among the frontline indices was the German index DAX, which ended with gains of just about 0.1%. And that's primarily because Lufthansa shares of the country's national airline, or the largest airline, fell about 6%, as the profits for the fourth quarter of Lufthansa came in 11% lower. We saw the shares tumble, and that took the German index, or put a lid on the gains that we saw on the German index.
All right, that was about the European markets. We'll get your check on our markets and the cues that you need to watch out for today. It's time for a quick break. Stay tuned.